Let's start with the elephant in the room. Why is gold moving the way it is right now? To understand where we are going by the end of the month, you have to understand the story the market is telling us today. Usually gold is simple. When the dollar is strong, gold is weak. When interest rates go up, gold goes down. That is the textbook definition. That is what they teach you in Finance 101. But look around. That rule book has been thrown into the fire. We have seen the dollar showing strength, yet gold refuses to crash. We have seen rates stay higher for longer, yet gold is hovering near all-time highs. Why? Because the market smells something burning. The educational lesson here is about divergence. When an asset stops reacting to bad news the way it should, that is not a sign of weakness. That is a sign of immense underlying strength. It's like holding a beach ball underwater. You can only hold it down for so long before the pressure becomes too great and it shoots up. Right now, gold is pricing in something that hasn't happened yet. It is pricing in a pivot, a failure, or a crisis. And February is the month where the cracks might finally open up. Think about the psychology of the average investor right now. They are chasing tech stocks. They are looking at AI companies. They have forgotten about the safety trade. This is exactly what the institutional whales want. They want you distracted while they accumulate. History tells us that the biggest moves in precious metals happen when the retail public is looking the other way. If you are holding gold or even silver right now, hit that like button. I want to see how many of us are paying attention while the rest of the world is asleep at the wheel. So let's break down the three massive catalysts that are colliding this month. First, we have the seasonality factor. This is pure data. If you look back over the last 20 years, January and February are fascinating months for precious metals. Typically, we see a run-up in January. The new year, new portfolio effect. But February is the battleground. It is usually where the initial rally gets tested. This is where the weak hands get shaken out. Historically, we often see a dip in the first 2 weeks of February, followed by a violent recovery into March. Why does this happen? It's the cycle of Chinese New Year and the Indian wedding season winding down. Physical demand shifts. But this year is different. The physical demand isn't just coming from jewelry buyers in Mumbai or Shanghai. It is coming from central banks. This is the second and arguably most important catalyst, the central bank buying spree. You need to understand this because it changes the floor price of gold. In the past, if gold dropped to $1,800 or $1,900, traders would step in. Now, sovereign nations are stepping in. China, Poland, Singapore, they are buying gold hand over fist. They aren't buying it to trade. They are buying it to hold forever. They are de-dollarizing their reserves. This creates a put option under the market. It means that every time gold dips this month, there is a whale with a limitless printing press waiting to buy that dip. That limits the downside risk significantly. If you are waiting for a crash to $1,600 to buy in, you might be waiting for a train that has already left the station. Now let's get technical. I want you to visualize the chart with me. Picture the weekly time frame. We have been building a massive consolidation pattern for 3, almost 4 years. A giant cup and handle, a triple top. Call it what you want. The point is, the energy built up in this range is massive. In trading, we have a saying, the longer the base, the higher in space. When price compresses for this long, the breakout isn't a small pop, it is a vertical line. So, what are we looking at for February specifically? We are watching the reaction to the economic data, the CPI, the PCE, the jobs numbers. Every single data point this month is a binary trigger. Here's the scenario. If we get data that shows inflation is sticky, meaning it's not going down as fast as the Fed wants, traditionally gold should drop. Why? Because it means the Fed has to keep rates high. But remember what I said earlier about divergence. If we get hot inflation data this month and gold doesn't dump, if it holds its ground, that is the signal. That is the market admitting that the Fed has lost control. That is when we target the highs. On the flip side, if the economy starts showing real cracks, unemployment rising, consumer spending tanking, the market will instantly price in rate cuts. And rate cuts are rocket fuel for gold. So heads I win, tails you lose. Not exactly. There is a bear case, and as responsible investors, we have to look at it. We can't just drink the Kool-Aid. The danger for February lies in the US dollar index, the DXY. The dollar is currently at a critical resistance level. If the DXY breaks out and starts rallying hard, it acts like a wrecking ball. It breaks things. It could force a liquidity squeeze where everything sells off. Stocks, crypto, and yes, gold. In a liquidity crisis, Cash is king. People sell what they can, not what they want. If we see a panic in the markets this month, gold could see a sharp, nasty wick down, a flush. But here's the secret that separates the pros from the amateurs. The pros love the flush. They have their buy orders sitting 5%, 10% below the current price, just waiting for that panic wick. They know that in a world of $34 trillion of debt, the dollar rally is temporary, but the debasement of currency is permanent. Let me ask you a question. When you look at your grocery bill, does it feel like your money is buying more or less? That feeling you have in your stomach when you pay at the checkout? That is the real reason gold is sitting where it is. It's the only honest report card on the economy. If you agree that inflation is vastly underreported, let me know in the comments. I want to hear your real-world experiences with prices, not just what the government tells us. Now, let's talk about the specific levels, the numbers. What are we aiming for by February 28th? To get the number, we have to look at the measured move. We are currently dancing around that psychological $2,000 to $2,050 area. This has been a ceiling for years. Every time we touch it, we get slapped down. But notice something? The pullbacks are getting shallower. In 2020, we hit the high and crashed to $1,680. In 2022, we hit the high and went to $1,620. But recently, we hit the high and only pulled back to $1,900 or $1,950. The floor is rising. The buyers are stepping up sooner. This is called absorption. The sellers are running out of ammo. By the end of February, I am looking at two distinct possibilities based on the data flow. Scenario A, the consolidation. We spend the rest of the month chopping around. We frustrate both the bulls and the bears. We trade between $2,010 and $2,060. This is the Max Payne scenario. It bores everyone to death. Options expire worthless. But this is actually bullish. It builds energy for a March breakout. If we close February anywhere above $2,050, that is a massive victory for the bulls. It sets the stage for new all-time highs in the spring. Scenario B, the breakout. We get one piece of data that tips the scale. Maybe a bank shows weakness. Maybe a geopolitical headline flares up. Gold rips through $2,080. Once we clear $2,080 with a daily candle close, there is no resistance. There is no historical price history above that to act as a ceiling. We enter price discovery mode. In price discovery, things get crazy. Algorithms start chasing. Short sellers get squeezed and forced to buy to cover their losses. In this scenario, we could easily see $2,150 or even $2,200 by the end of the month. It sounds aggressive, I know. But moves in gold, when they finally happen, are violent. Remember, gold can do nothing for 5 years and then do 5 years worth of moves in 5 weeks. I want to take a second to talk about the trap I mentioned in the beginning. The trap is leverage. Because the conviction is so high on gold right now, retail traders are piling in with high leverage. They are betting 10x, 20x, 50x their account size that gold goes up. Market makers see this liquidity. Before we get that move to $2,200, do not be surprised if we see a stop run. This is where the price drops sharply, takes out the low of the previous week, triggers all the stop losses of the retail traders, and then immediately reverses back up. It happens in the blink of an eye. If you are watching the chart minute by minute, it will give you a heart attack. If you are zooming out and looking at the big picture, it's just a buying opportunity. This is why education is key. You cannot trade gold with emotion. You have to trade it with logic. Let's contextualize this with what is happening globally. We have tensions in the Middle East. We have a war in Europe. We have an election year in the United States. Uncertainty is the fuel that gold runs on. And 2024 is the year of uncertainty. Usually during election years, the incumbent government tries to pump the economy. They want the stock market high. They want voters to feel rich. This usually means loose monetary policy, printing money, stimulus, spending. All of that is inflationary. All of that is bullish for gold. So even if February is choppy, the macro wind is at our backs. But let's get back to the prediction. I've analyzed the options market, where people are placing their bets with real money. The smart money is positioning heavily for calls, betting on the price going up, striking around the $2,100 level for March expiration. This tells us that the big players expect the price to be moving toward that level as February closes. They are not betting on a crash. They are hedging against a spike. So, here is my official forecast for gold, GC, by the end of February. I believe we are going to see a fake out to the downside early to mid-month. We might test $1,980 or $2,000 flat. This will scare the tourists. It will make the headlines say, "Gold is dead." Ignore that. By the final week of February, as the market digests the reality that rates are not going up anymore and cuts are coming, I see gold reclaiming the $2,050 level and making a push for $2,090. My target close for February is $2,085. Why this specific number? It puts us right at the doorstep of the all-time highs, ready to kick the door down in March. It is high enough to keep the bullish trend intact, but not so high that it overheats the RSI and forces a correction. It is the perfect launch pad. However, if we close February below 1950, then the thesis is broken for the short term. We have to be honest about that. If we lose 1950, we are looking at a longer correction. But given the fundamental backdrop, I assign that a very low probability, maybe 15%. The odds are overwhelmingly in favor of the upside. Now, a warning. If you are investing in physical gold, none of these daily fluctuations matter. You bought insurance on your house. You don't check the value of your insurance policy every day. You just sleep better knowing you have it. But if you are trading paper gold, ETFs, or mining stocks, February is going to be volatile. The volatility is the price of admission. You have to be willing to stomach the swings, to catch the trend. One thing we haven't touched on enough is the mining stocks. They have been lagging behind the metal price. Usually miners act as a leveraged play on gold. If gold goes up 1%, miners go up 3%. Recently that hasn't happened. They have been beaten down. This represents a massive catch-up trade. If gold hits my target of 2085s by month end, the mining sector could see a massive rotation of capital. We are talking about 20 to 30% moves in individual stocks in a matter of weeks. This is where the real asymmetry is. Buying gold preserves wealth. Buying the right miners at the right time builds wealth. So to recap, we have seasonality fighting against us early in the month, but central bank buying supporting us. We have a technical setup that is coiled and ready to explode. We have a macro environment of debt and war that demands a safe haven. We have a target of $2,085. The danger zone is the mid-month data dump. Watch the DXY. If the dollar spikes, don't panic, sell. Look for the support levels, look for the buyer absorption. And remember, the crowd is usually wrong. When everyone was screaming buy crypto at the top, it crashed. When everyone was screaming sell stocks at the bottom, they rallied. Right now, the crowd is bored with gold. They think it's an old man's rock. That is exactly why it is ready to move. Investing is the transfer of wealth from the impatient to the patient. February is going to test your patience. It's going to try to shake you out. But if you hold the line, if you stick to the data and ignore the noise, you will be positioned for what I believe will be the breakout of the decade later this year. I want you to be ready, not just for gold, but for the asset that usually follows gold, but moves 3 times as fast. The asset that is currently more undervalued than it has been in 50 years. I'm talking about silver. If gold hits 2085, silver is going to do something absolutely insane. The gold to silver ratio is screaming by, but that is a whole different set of charts and data points. If you want to know my targets for silver and how to play the catch-up trade, make sure you are subscribed. You do not want to miss the next video. We are going to break down the poor man's gold and why it might make the rich man rich. Thanks for watching. Keep your head on a swivel, manage your risk, and I'll see you on the next one.